Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. Spotify reported earnings this morning, and there was a little bit for everybody. There was a ton of growth in users and revenue, but there was still a lot of pressure on margins. So I want to dig into the numbers, what management talked about on the conference call, and how investors should be thinking about this company and the stock in the future. My name is Travis Hoium. Thanks for watching Rive Investing. Please subscribe here on YouTube for all my content, and I'll put a link in the show notes to a deep dive that I did on Spotify and why I think this is a 10x investment over the next decade in my newsletter, Asymmetric Investing. But I want to first look at the high-level results. This is the high-level results for Spotify, and the big thing that popped out here is the user number. So what Spotify does here is left to right, we have Q1 2022, Q4 2022, and then Q1 2023. So the last two numbers are the sequential numbers. 5% growth in total monthly active users is just tremendous for a technology company because that's only 3 months and the number of users increased by over 25 million in that short amount of time. Premium subscribers did not jump all that much, only 2%, but ad supported monthly active users was up 7%. So the management really talked about this. The way that the funnel works for Spotify is typically that a customer will come in as an ad supported member. They're not paying that monthly fee to be a premium subscriber. And then over time, they will eventually become a premium subscriber. That's pretty typical. That's pretty typical in a subscription business like this, but that's exactly what we're seeing here. More growth on the ad supported side of things than on the premium side of things. From a financial perspective, no real growth on the premium side of the business quarter over quarter. That's in part due to some promotions, in part due to currency fluctuations. So there's a lot of things that go into that number there. And then from the advertising side of things, down quarter over quarter. But remember that Q4 is the holiday quarter. So that's going to be annually the high watermark for the year. So up 17% year over year. I would like to see more growth in that segment. But again, this is the kind of investment and business that it's going to take a long time to grow a lot for Spotify, because they are working largely with bigger advertisers. So those ad spend dollars don't just instantly flood into a company like Spotify. It takes months, quarters, and even sometimes years to start to increase their ad spend, especially as they're opening up more ad space in things like podcasts. Operating loss was $156 million, but free cash flow did turn positive again to $57 million. So Spotify has typically kind of been in that break-even free cash flow range, maybe a little bit positive, but not a lot of big changes there. Here's most of the same numbers, but compared to the guidance that they gave. So you can see that the user numbers were significantly higher than they gave for guidance. Revenue was a little bit lower because of the factors that I talked about earlier, and then gross margin came in a little bit higher as well. Here's a couple of things I want to highlight on the revenue side. One thing I think is really interesting is Q2 2020 is really when the pandemic began. So if you think about Spotify's business, one of the theses that I think a lot of investors had was when the pandemic began, people started listening to more podcasts, listening to more music. They just had more time to do those kinds of things. So Spotify was going to be one of the beneficiaries, at least short term. But a lot of companies that had short term benefits during the pandemic, those have really waned in the last few quarters. That's not what we're seeing with Spotify. You can see that premium revenue is up, advertising revenue is up, and like we talked about earlier, that user number is up as well. So I think that's really telling about the long-term strength of the company. Now they need to turn this into profits, but if you're having more users, but in a technology business or in a streaming business, the fact that they're growing that user base and the revenue overall, I think is really the first step to becoming a more powerful company. And that's exactly what we're seeing from Spotify. The podcast business is also continuing to slowly but surely improve. Podcast revenue grew nearly 20% year over year, driven by original and exclusive podcasts. The other thing to consider in the podcast side of things is that Spotify includes all of their exclusive podcast costs in the advertising side of the business. So that margin from advertising is going to be lower, at least for now, until some of the deals that they have on the books start to go off and Spotify starts to have lower costs on the podcast side of things. This is exactly what I was pointing to there. Gross margin from the premium side, 28.6%. On the ad supported gross margin, negative 3%. So some of the changes that management talked about last quarter with not investing as much in exclusives, that's going to take not only a few quarters, but probably a year or two to really impact the company's gross margins on the ad side of things. The other thing that I would like to see is more growth on the ad side, because this is really the opportunity for Spotify to become a more profitable business, is if they can leverage the technology that they've invested in. So as more people are listening to Spotify, especially on that free tier, they're going to be able to monetize those users a little bit better. So looking for more progress there, and we're just not there, but it's still very early in that strategic change. Here's the other thing to watch is operating expenses. You can see that there was tremendous growth in operating expenses late in the pandemic, and that I think was ultimately a mistake by Spotify. They're starting to reverse that and cut those expenses. You can see that there's some severance expenses here. That's part of a layoff that was happening earlier this year. And management said that'll take a little while to trickle through the system. The last two things that I want to cover is where these monthly active users are located, because I think that's what's really interesting is as Spotify has built its business around the world, it's been able to compete more effectively with a lot of its competitors, and it's created a nice competitive moat. This is the chart showing exactly where the percentage of customers are coming from for overall monthly active users. You can see that a lot of the growth in the last few years has been in the rest of the world. So not in Latin America, North America, or Europe. Actually, Europe is falling in its share from 36% in 2019 to 30% this most recent quarter. So that's positive from a breadth of the business standpoint. If we go down to premium subscribers, the story's a little bit different because the wealthier countries are going to be more willing to pay for that premium service. So no surprise here that Europe and North America are the two biggest segments for Spotify. And that's likely to continue for the foreseeable future. So for Spotify, I think at the end of the day, the thesis is still intact. This is a company that wants to own your ears. It has over 500 million users now. It's growing in premium and in the ad-supported side of the business. The challenge is those margins, and that's something that changes that have been made over the last 6 months or so are going to take a couple of years to really be implemented and be shown in the financial statement. Management would like to get those gross margins up to in excess of 30%, and we're definitely not there yet, particularly on the ad side of things, but there is a lot of opportunity to increase those margins there. The great news is that more and more people are using Spotify. And that's something that eventually the company will be able to leverage. We've seen this with all kinds of other streaming services from Netflix to Disney, that if you get users and you get them used to using your platform, eventually you can do things like use more, like put more ads in the service or increase your prices. That's exactly what we're seeing with Netflix and Disney right now. And I think we're going to see it with Spotify in the next few years. So keep an eye on that. That is why I'm still bullish on this company. But what did you think about the results? Leave your comments in the comments section below. Don't forget to subscribe to Rive Investing. Thanks for watching, everybody. I'll see you here next time.